In today's video, we're going to do things a little different, as this is one of the most requested videos I get. So for those of you that requested it, here you go. In today's video, we're going to be looking and ranking 5 popular ETFs. These are going to be based on my opinion alone and how they would or would not fit within my portfolio, ranking 5 ETFs from best to worst. And I figure you probably want to know which ETFs we're going to be talking about ahead of time. So I'm not even going to make you wait. The 5 ETFs are going to include SCHD, QQQ, VGT, JEPI, and ARKK. So we're getting a good mix of growth, technology, dividends, so there should be something for all types of investors. And when we dive into each of these ETFs, we're going to look at past performances, expense ratios, future performance, and today's holdings. So before we dive in though, do me a huge favor. Simply show your appreciation by simply clicking that like button down below. Subscribe to the channel, and let's get into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And as I already mentioned, today we're going to be talking about ETFs. And ETFs are a great way to diversify your portfolio. But as you know, ETFs that we're talking about is just diversification among stocks. And most experts agree that it is important for investors to diversify amongst various different asset classes. All of this helps protect against volatility. In fact, JP Morgan Asset Management just stressed this in their 2025 outlook, saying that traditional stock bond framework, that 60-40 we've always heard about, may be reformed into one that also includes alternative assets. A 2022 report from Citi and Masterworks details an alternative asset class that actually has a low correlation to a range of other popular assets. Now, over the last 30 years, Citi is actually talking about blue chip contemporary art, which sounds like an obscure asset class. Until you consider that billionaires who sit on 9-figure plus art collections like Microsoft co-founder Paul Allen. While the JP Morgan Outlook didn't cite contemporary art specifically in their report, other studies like a 2023 one by Deloitte estimates that overall art and collectibles wealth at nearly 2.2 trillion, and they project that to hit 2.9 trillion in 2026, leaving plenty of room for potential upside. That's why I believe you should check out today's sponsor, Masterworks, while you're early on the scene. Their art investing platform has already distributed back a total of over $60 million, including principal in investor proceeds across their 23 exits. And you don't need to be an art expert to get involved. You also don't need millions of dollars and can diversify between multiple paintings. And while I'm not an investor personally, Masterworks has over $1 billion invested capital across their 450 plus offerings. So if you're interested in learning more and want priority access, check out the QR code on your screen or the description down below, or you can go to masterworks.art/Mark Roussin. All right, let's jump back into our video ranking 5 popular ETFs from best to worst. In fact, we're going to do it in reverse order, and I'm going to give you my worst ETFs that probably likely will never enter my portfolio, at least number 5, and then we'll move our way up to the best ETF on today's list. So let's get started with ETF number 5, which is going to be the ARK Innovation ETF, stock ticker ARKK. This ETF is led by Cathie Wood's ARK Invest, and this is one, again, I would never touch. Why people even invest in this ETF is completely beyond me. I like to refer to them often as one-hit wonders. Let me show you what I mean. Looking here, you can see that ARK Innovation ETF has assets under management of $6.9 billion and has returned 34% over the past 12 months. Not that bad. However, the fund was saved in the past few months alone, since through the first 10 months of 2024, the fund was actually down more than 10%. And they can thank Palantir and Tesla since November for a lot of that comeback. However, if we go back to the pandemic days, when things went parabolic, ARK was a hot name, primarily for its positions in Bitcoin and Tesla back then. From the March 2020 lows of the market until peaking in February of 2021 for ARK, shares climbed an impressive 205%. Very solid. However, since then, they have done nothing. Zero to show for it. In fact, negative. Investors that decided to stick around have seen their gains turn to losses because since those February 2021 highs, ARK is down nearly 60%. 60% in a 4-year period. During that same 4-year period, the S&P 500 has climbed nearly 60% itself in the other direction, the positive direction. That there is the definition of a one-hit wonder. So I guess we need markets to go parabolic in order for ARK to make money. And on top of all that, giving you impressive negative 60+% losses over the past few years, they're also going to charge you a 0.75% expense ratio. And when it comes to investing in my personal portfolio, I will never invest in an ETF or any fund that has an expense ratio of more than 0.5%. All right, now let's take a look at the top holdings, which include Tesla, Roku, Coinbase, Roblox, Palantir, Robinhood, Shopify, CRISPR, Block, Tempus, and those are the top 10, which account for roughly 64%, and there's 34 total holdings within the ETF. So a list of very high growth companies, which can add to a lot of volatility. And if it wasn't really for Palantir and Tesla over the past few months since the election, this could be an ETF that's in major trouble. In fact, it has been since 2021. And again, this is an ETF that will never enter within my portfolio. And now we're going to take a step up and move into ETF number 4, which is going to be the JP Morgan Equity Premium Income ETF, also known as JEPI. You've heard me talk from time to time in other videos in the past on talking about JEPI, comparing it to the likes of SCHD or its sister fund, JEPQ. JEPI is an income-based ETF utilizing an option strategy to increase and juice that high premium that they're able to distribute on a monthly basis. The primary option strategy that JEPI and its managers use is what's called a covered call. And a covered call can bring in premium, but at the same time, during a bull market, it's going to cap the upside that you have in those underlying positions. And the other reason that I don't like to invest in JEPI all that much is the fact that I utilize options on a weekly basis. And you can track all of my option plays within our Stock Investors Edge subscription, the Options Edge Plus subscription, where we give out weekly reports focused on education and detailing many of our plays. You can check out a link to that down in the description below. Looking back closer at JEPI, you can see that it has assets under management of nearly $40 billion. Over the past 12 months, shares have only climbed 5%, and they have an expense ratio of 0.35%. Although I'm not crazy about the expense ratio, it's not all that bad for an actively managed ETF. But as I mentioned, the upside can be capped when utilizing a constant covered call strategy, hence the only 5% return we have seen over the past 12 months. During that same time period, we have the S&P 500, which has climbed nearly 25%. Now let's take a look at the top holdings for this ETF, which include the likes of Meta Platforms, which has been on a great run, Amazon, MasterCard, Visa, Progressive, Alphabet, Trane Technologies, Thermo Fisher, AbbVie, and Southern. In total, the ETF has 132 positions. So if income is what you're focused on and chasing within your portfolio, then JEPI or the likes of a JEPQ even are going to be great options. But for me, in my phase and still trying to focus on growth and total return, it's just not in the cards. The yield currently sits at 7.2%, but it's more of a moving target because it will be based on how profitable the option trades are for those months. More profit equals higher yield. So for me, the focus is not just on income, which is why I rank it in the 4-hole here. And now moving on to the final 3 ETFs, they could really go in any order. But the third one we're going to be focusing on is going to be the Vanguard Information Technology ETF, stock ticker VGT. Now, VGT is an ETF that held a spot within my portfolio for many years early on in my investing journey. But as my portfolio continued to evolve, and as myself continued to evolve as an investor, utilizing more option strategies, as I mentioned to you, VGT exited my portfolio. And for one primary reason, it was heavy in technology. In fact, it was primarily technology. And although I wanted heavy technology exposure, I wanted more of a diversified approach. And on top of that, I wanted more exposure to the likes of Amazon, Meta, and Alphabet. 3 major companies that are not included in the likes of VGT. The ETF currently has $99 billion in assets under management, an expense ratio of 0.10 considered a low-cost fund, and a small dividend of 0.6%. The goal for this ETF is pretty simple: technology exposure. No one is investing in this particular fund for that dividend yield. The top holdings include Apple, Nvidia, Microsoft, Broadcom, Salesforce, Oracle, Cisco Systems, Accenture, ServiceNow, and IBM. In total, the ETF holds 319 positions, with the top 10 accounting for roughly 60%. Many fantastic tech companies you can see on this list. Since the start of 2023, after we went through that rough patch in 2022, the markets have been led primarily by technology and Mag 7 companies. So it should be no shock that VGT, looking at past performance, has done quite well. Since the start of 2023, VGT is up nearly 100%, with the S&P 500 up roughly 60%. VGT is certainly a great ETF, don't get me wrong, especially if you're light on technology exposure and you are looking specifically to increase that exposure rate there. And that's going to lead us now to number 2 on our list when it comes to ETFs. We're getting into the best phase now, and these top 2 could have gone either way. But number 2 on my list is going to be the Schwab US Dividend Equity ETF, stock ticker SCHD. And when we started this video and you heard SCHD was in it, I bet there was a number of you that thought SCHD is going to be number 1 on this video. But not today. Today's form of SCHD isn't really my favorite compared to years past. Just look at last year when Broadcom was at the helm of SCHD. That was probably one of my favorite years. The ETF currently has assets under management of $68 billion, and over the past 12 months, shares are up roughly 9%. The ETF has a low expense ratio of just 0.06%, the lowest on our list today. SCHD is easily the best dividend-focused ETF on the market today, in my opinion. It has the highest yield than many high-yield-focused ETFs. It has faster dividend growth than most dividend growth-focused ETFs. It takes a diversified approach, and it's not heavy in technology exposure. Although that's been the Achilles heel for the ETF over the past few years, I like to diversify my portfolio. And when technology isn't working, SCHD is going to be there to back up my portfolio. I have plenty of tech exposure. This helps me offset that. As you can see here, financials is the top sector for the ETF, followed by healthcare and then consumer staples, with technology down the list accounting for only 10% of SCHD. Here's a look at the top holdings, which include AbbVie, Pfizer, Amgen, Bristol Myers, Cisco Systems, Coca-Cola, BlackRock, The Home Depot, Chevron, and Verizon. In total, the ETF has 102 positions, with the top 10 accounting for roughly 42%. This is an ETF where we're going to be getting an update to the portfolio, one that many are going to hopefully cheer, because SCHD goes through its annual reconstitution every March, so we're counting down the days. Looking here now at the dividend, you can see that SCHD provides a yield of 3.6%. They have a 5-year dividend growth rate of roughly 12% and 13 consecutive years of dividend growth. SCHD can provide stability, diversification, and growing income. And now we're going to get to my favorite ETF on today's list, which is going to be the Invesco QQQ ETF, stock ticker QQQ. Why is this number 1? Well, first and foremost, it's technology focused, but it takes a much more diversified approach. As you can see here, in the sector breakdown, technology accounts for 50% of the fund. So again, heavy technology, but not just technology. The other 50% is sprinkled across other sectors. The other reason on why I'm such a big fan of QQQ is what I talked about earlier, in the fact that I utilize option strategies on a weekly basis. And when you talk about the most traded ETFs when it comes to options on the market, it's going to be the SPY, QQQ, and IWM. Those are the 3 ETFs that I focus on when it comes to options on a regular basis. QQQ currently has assets under management of $330 billion, and over the past 12 months, the ETF is up 24%, and it has an expense ratio of 0.2%. If you're buying QQQ just to buy and hold for the long term, then check out QQQM, which is pretty much the same exact ETF with the slightly lower expense fee. But if you're utilizing it for options, the regular QQQ is going to be the better bet. When you look here at the top holdings, you will see a lot of familiar names: Apple, Microsoft, Nvidia, Amazon, Broadcom, Meta, Tesla, Alphabet, and Costco. In total, the ETF has 102 positions, with the top 10 accounting for more than 50%. Tech heavy, but you also get other companies, other high quality companies from other sectors that are mixed in. I love Meta, I love Amazon, and Costco has been completely on a tear. Looking out over the rest of 2025, I continue to believe that the triple Qs can continue to perform at a great rate. And when it comes to performance, here's the performance year to date so far for all 5 funds that we've looked at. ARK is up 10%, leading the charge, followed by the triple Qs at 3.5% gain, JEPI is up 2.5%, SCHD up 1.5%, and VGT is bringing up the rear at up 0.8%. Looking back at the past year, 2024, here's how all 5 ETFs compared to one another. VGT was the best performing, up 28%. QQQ was up 25%. ARK up 8%. SCHD up roughly 8%. And JEPI was up 5%. So we'll have to see how 2025 shapes out, as every year presents its own unique set of challenges. So there we just looked at 5 popular ETFs, some of which are already in my portfolio, but some that will never enter my portfolio. We ranked them from best to worst, or in fact, we went from worst to best. Let me know down in the comment section how you would rank these 5 ETFs, and if you agree with my rankings or what changes you would make. And if you haven't done so, please hit that like button down below, subscribe to the channel, and we'll see you in the next one. Take care.